So thank you, Jorge, for the introduction. First, we very much appreciate everyone joining today, whether you're a software client, whether you're a technology, whether you're a valuation advisory client. So thank you for the discussion. We appreciate the continuous feedback we're getting. And what we wanted to do today is highlight some of the discussions we're having with clients. And so what we want to do is include both Matt and Bill, two current clients and customers we work with, for their feedback, challenges, and commentary on benchmarking. So Matt, if you could introduce yourself to the group.
How's it going? So Matt Gilbert, head of global analytics at CBRE AM, overseeing effectively our performance analysis and a lot of our benchmark analysis, but also starting to dip a little bit more into our operational metrics as well.
Hi, Bill Maher with RCLCO Fund Advisors, the institutional advisory part of RCLCO. I've been there about 5 years. I'm the head of strategy and research. Before that, I was head of strategy and research at LaSalle Investment Management for 25 years. And just sort of following up on Jorge's comment on growth, I joined LaSalle in 1995, and it was 700 people in the U.S. only. And I just looked it up. JLL is now 112,000 people in 80 countries, showing the growth and consolidation that's gone on. And CBRE is much bigger than LaSalle, JLL. So you got some. I can speak to the big side, but RCLCO is basically a strategy consultant to LPs only, mainly the big U.S. pension funds.
So logistically, we are going to have a number of questions to the panelists for the first 30, 35 minutes. We want to make sure there's 10 to 15 minutes for Q&A from the audience at the end. So I'm looking for Brandy or someone in our marketing team, if they can flag me to let me know once we've hit our time limit. I don't see a timer. But without further ado, maybe Matt. I know that we've worked together over a number of years, but how does your firm or institution incorporate benchmarking in decision-making? What part of the real estate life cycle are you looking at it? What type of comparative analytics?
Yeah, it's a good question. When we think about benchmarking as it relates to investment decisions, I don't think in terms of looking at the analytics is going to drive the decisions that we're going to make in the future. But in general, it actually provides, as we dig a little bit deeper, just a better feedback loop to the people that did make the decisions in terms of what they did in the past. So it's as my entire career has kind of evolved, especially in the last 10 years, getting more deeper into analytics and providing better quantitative measures to tell people what they did and why it was either good or bad. It's evolved. There's a lot more excitement for it, as well as a lot more feedback from those people. So,
okay. And maybe Bill at RCLCO.
Sure. I think our main goal is to help clients beat the benchmark, and 70 to 80% of the time it's Odyssey, maybe Odyssey with 100 basis points if it's a more than core portfolio. And looking back at Odyssey, it's been real easy to beat Odyssey, particularly going back 15, 20 years ago. It was it was like 40% office. If you kind of looked at the data, you would see that office was a poor performing property type. So by underweighting office, it was very easy to beat the benchmark. I'd say nowadays it's 13% non-major property type. There's a lot of really good property types that you can overweight to beat the benchmark. Odyssey's gotten a little bit weird in that 60% of the benchmark is industrial and apartments. So that's a little bit tougher call whether to underweight or overweight those. But we're looking closely at the components and particularly the property types and making pretty big bets against the benchmark to try to outperform. So I think that's we'll continue to keep doing that.
And maybe, Bill, when you think about benchmarking, and if it's, as Matt said, historical performance or how you have done, how do you overlay forward-looking analytics, expected outcomes, uncertainty, sort of the forward look on those?
Yeah, no, everyone has sort of models on how they think the different property types will perform in terms of rent growth, cap rates, capital flows, and for every and now we used to track 4 property types and maybe some sub-property types, but now there's 5 or 6 niche property types: senior housing, data centers, manufactured housing, various these niche so-called niche property types, which we think will become much bigger. So we're internally forecasting those and also trying to both overall and by geography.
And Matt, to you, how has your approach to benchmarking changed over the years? Or is it always Odyssey? Are there other indices you're looking at? And then is it strictly the traditional sort of attribution work, or are there other frameworks that you've seen change throughout your career?
Yeah, so like the method of benchmarking for our Odyssey fund, of course, is within Odyssey, but we still like to branch out, especially if we're looking at valuation metrics and you just want more contextual information about what's going on in individual markets, looking at CoStar, looking at other data sets to actually contextualize what did happen, what possibly could have happened within the benchmark, get a better idea of things. When it's not Odyssey related, we're starting to look at PMEs or direct alphas to compare how do we do versus a set either benchmark or an index. And so there's just a lot more work to be done, which is it's pretty exciting. And it seems like the investor demand as well as our portfolio managers demand is starting to kind of wake up to some new measures and new ways to look at how we're performing.
Can I jump in? Just
Sure.
A big issue among pension funds is what's the appropriate benchmark. Many of them settle on Odyssey, been using it for 20 plus years, and realize it doesn't reflect their portfolio in that it's core, low leverage, and maybe not reflective of property types. So the main issue, though, is that it's a core index, and they're using it for their whole portfolio. A few are adding 100 basis points, maybe 200 at the most, to account for the fact that they might have some non-core. But that's kind of a simplistic way of doing it. We're pretty excited that there's a group called Burgess, which got bought by MSCI recently, and Burgess tracks all of the open-end funds in private equity world, including real estate. So they have, I think, 2,000 private equity real estate funds, and they are in the process of developing a core plus benchmark, a value add benchmark, and an opportunistic benchmark. And we think, like all other stocks and other asset classes, you won't have a real estate benchmark. You'll have a core benchmark. You'll have it by style, and I think that'll be a major improvement that I think our clients are ready for, and we'll be advocating to do it that way.
And Bill, in addition to differentiating by risk profile or strategy type, what's the most difficult data point you get asked either by investors to provide, or when you were previously working as an advisor, the most difficult data point you found, either because it was manual or it's tough to get your finger on?
Well, I just, income yield versus cap rate, and they can vary a lot over time. They do right now. The Odyssey income yield is 4.2, I believe, as we speak, and the market is for Odyssey properties is probably a 5 cap. So we just get asked to explain, how does that make sense? Should we be selling all our Odyssey funds? How do we make sense of a valuation of 4.2?
And maybe Matt, on your end, what's either the most difficult data point you get, or what's the data point where you have to do the most manual work, either for investors or the portfolio management team?
What's the most difficult one?
While you're thinking, I was just going to say that what we have to explain is that a 3-something income yield for industrial is because there's a mark to market of 20% or so on the rents that will get you up to a more normal level, but that's not a concept that everyone can pick up quickly.
And I'll give you
I would say so. One, income yield, I definitely agree with it, especially explaining it to prospective investors of being a backward-looking metric. It's not actually a true indication of what your distribution yield is going to be, just some of those things. But I would say like spreads between core, value add, and opportunistic as it relates to from our valuations, and just explaining to potential investors what that actually means and what makes sense for those risk premiums on it, as well as contextualizing what that means versus benchmarks like the Altus data set.
I would say on the Altus side, we wish we knew what was a Class A office building and what was not. That would have helped everyone, I think, in the room.
There's only about 10.
Yeah. Or what's a AAA? So we wish we knew. But I think that's a question we've gotten a lot the past couple of years. I mean, maybe this goes to sort of the strategy type, the core versus core plus. But what do you think is the biggest limitation with the data sets? Is it integrating the data? Is it just you can't get down to the asset level, street level? Like where do you think the data stops, or what data do you wish you had that you could, have better explanation?
Yeah, I mean, I don't really deal with property level data. I deal with, and I think NACREIF's done a tremendous job of, refining their database, making it accessible. I can do lots of slicing and dicing. There are masking criteria that stops me a little bit, but I don't really have to get down to really small geography ever. So, I think at least on what I try to do, I think I have really pretty good data.
Yeah, I was just going to say granularity of information. There's just a hunger to get more and more and just get more information and get more coverage, especially as it relates to like secondary and tertiary markets, just within either the NACREIF data set or the DataBridge data set. Just getting right is because we're competing and benchmarking versus everybody else. But if things drop off of the data set because of masking, then you sometimes lose understanding. So it's just the hunger for more information and more people submitting and just getting a better idea of how smaller markets and smaller subtypes are doing.
And have you seen a disparity, or is there a gap between sort of the core office, retail, industrial, and apartment, and then sort of the alternatives? We're hearing a lot more investment there. Earlier session, there's a lot of talk about alternatives in real estate. Do you think the data is in parity, or do you think there's sort of a gap between the availability of data in the core property types and then the new alternatives?
Yeah, definitely. I mean, it's the percentage of whatever data centers, anything in NACREIF and other places is, it's small at this point. It'll grow over time. So
maybe a question, and we think back to pre-COVID 2019. What do you think we've learned over the past 4 or 5 years about benchmarking, transparency, better analytics, and then really where do we still have gaps? Or, hey, if we've made some progress, that's great, but where do we need to go in the next 2, 3, 5 years, in your view?
I'd say better data on non-core. I think on average, institutional portfolios are 2/3 core, 1/3 non-core. A lot of them are funds. And just sort of more, better benchmarking on non-core. If you have a fund and it's got some development that's 20% leased up at some point in time, is that good, bad? Sort of more on the non-core side would be great.
Yeah, I would say the ability to have more attributes to look into things a little bit more, just so you're not like hair-strung to the current attributes that are either available within the Altus data set or the NACREIF data set. Just having an ability to pivot the information, run more queries, have a better understanding of the data set by more information and attributes.
And just curious, at your respective firms, how many different data sets or vendors or providers do you guys use? Certainly we hope you use the Altus valuation data set, but, and again, not a specific number, but do you have one data provider for valuation metrics, one data provider for sales, one data provider for forecasting? Like, approximately how many different data sets are you taking and then merging into internal decision making?
I'm gonna have to get back to you on that. That's a lot. It's a lot. It's not just one. It's
at least 10.
It's at least 10.
And by property type, by operation, by financial performance. It's
Yeah.
a lot of different things.
Yeah, and also when you start talking about also public markets as well, are we, like, what are we calling a single data set with a public market, right? Are you saying like one Bloomberg terminal counts as one data set, or, yeah? I don't know if that's a fair comment, but.
Yeah, no, I mean, there's tons of REIT data out there on both performance and operations that, you can aggregate. We use a firm that does that for us, but, there's lots of public data out there.
Yep.
When considering real estate analytics comparative analysis, how do you think real estate compares to other asset classes, stocks, bonds, et cetera? Are we similar? Are we falling behind? How do you judge CRE's measurement relative to other asset classes?
I was just on a panel at a group called RERI, Real Estate Research Institute, yesterday on benchmarking, and it was discussing a paper that looked at benchmarking across all the private asset classes. And it looked at, and particularly actually real assets. So it looked at timberland, it looked at, farmland, all the infrastructure. And actually, real estate is by far and away the best. It's got, it's got a clear benchmark. It's got several benchmarks that are good, have been in use for a long time. They're all relative measures. They sort of meet all the key criteria. So real estate actually stands out among real assets as having the best benchmark situation. Again, the only thing that's kind of missing is that risk level enhancement, I guess. But a lot of like infrastructure, people are using CPI plus 5 or something, kind of a made-up number, and at least real estate is got a very good relative benchmark. And I also say that I don't know if you're familiar with a group called IDR, which basically is a fund of funds of Odyssey funds, and you can actually, through them, you can invest in the benchmark. And a lot of big pension funds who've had, let's say, 4 or 5 Odyssey funds are saying, it's not worth my while to think about, which Odyssey funds I should be in. And if I get it right, I might get 20 basis of outperformance. It's not worth getting 20 basis of underperformance, which they get, everybody would get upset. So there's a movement of some of the bigger funds just say, trade all those funds into IDR and just get the benchmark returns for your core and call it a day, because there isn't much upside and downside. The downside's worse than the upside, I guess. So that's a trend we're seeing. I think will continue.
Yeah, for the privates, I think it's got to be the best, just because granularity of information, timing of information, we get quarterly appraisals. When I did some work on our farmland, timberland, I have an infrastructure group that reports up to me. It's just real estate in general is just so homogenous, and so it's just so easy to actually understand how you're doing, how the rest of the market is doing. Like with infrastructure and investing into infrastructure companies, like it's really hard to compare one infrastructure company versus another. It's very easy to compare one industrial building next to another, and so just the granularity and the availability of information is by far, I don't know, I think it's the best across privates.
So we had a discussion earlier, and one of the comments was we think benchmarking has gotten better. We think it's very helpful. But if we make it too homogeneous, then we think everything is the same, or we use a broad brush. So at your firms, do you think about that, or is there a feedback loop such that you certainly want to measure correctly, but you also have the opportunity to sort of, make certain decisions, or there's a certain band of consideration that's reasonable? And if it's too formulaic or too structured, then inherently real estate is slightly inefficient. No two buildings are the same.
I mean, you're talking to a very analytical person, so I want everything to be on a basis point basis. But at the end of the day, yes, it's always going to be an art before a science. But I'm just hopeful that the science gets a little bit bigger, that quantitative measures really drives how things are being valued and how things approached, while there can still be abstract like spreads and differences according to like individual property differences. Yeah.
I mean, Bill, in your research role, do you agree with that, or do you think, as we were talking about before, no, it should be a formula and it's
Yeah, I guess I'm not following your question. Are you saying should the benchmark be somehow defined better? I'm not.
So one of the comments we got earlier was the increased transparency in benchmarking is very helpful, but the concern is everything drives to just that benchmark, and there should be an understanding that there is a dispersion of the data. There is a difference.
Well, isn't that good in that if you want to have real estate exposure, you can again achieve the benchmark returns and with presumably low costs? That should be an option out there. And then there's always development and other things, and you can bet against the benchmark in terms of property types. But if there is, again, you can. I mean, how many pension funds just have an S&P index or something like that as a big part of their portfolio? Why shouldn't real estate have something similar?
Yeah, are you referring to returns or like benchmarking our properties from a valuation perspective? Because, yeah, sorry, go ahead.
So the comment earlier was strictly on valuations.
Yes.
Oh, okay.
Yeah,
There's a question about, hey, the weighted average discount rate is 7.2, and because I'm 2 basis points lower, I should be at 7.2. And the comment was, there should be a tolerance level for better or worse buildings. We always try to remind that the benchmark is an average, and so there's certainly dispersion of data around there.
Yeah, I think people miss the point that valuations are probably plus or minus 5%, 10%. You tell me, something that, if you ever tried to trade, you're never going to get that number exactly. And you look at the public markets. I mean, there's I was just looking at life science is right now trading at 20% under intrinsic value. Hard to define, but people try. So the public markets can swing up and down 20+%, given the what the private market would have a very precise number for.
And maybe last question, if you could either wave your magic wand or have a perfect benchmarking solution, like what would that look like? Or how do you think about that at your firm, or where do you think we need to get to in the next 2, 3, 5 years?
Go ahead.
Yeah, so from a valuation perspective, just I resource my team to be able to take very large data sets, mixing them up, and provide visualizations out to our entire firm. So what we like is just as much granular information with as most attributes as humanly possible. But other firms don't necessarily have the same resources that we have. And so the size of the manager obviously matters, but at the end of the day is the ability to understand what happened, contextualize it with quantitative measures, and then describe to your portfolio managers and your investors the story of why your portfolio did the way it did versus the benchmark. And having a benchmark tool that helps you explain that as soon as the benchmark is released and before we actually have to have those calls with investors, that's obviously the most ideal, is the timing, the accuracy of information, as well as the level of detail to explain your yield.
So when we do investment analysis, we use a Monte Carlo approach, so probabilistic range of returns, and we're trying to look for situations where there's more upside than downside. I don't know why an appraisal couldn't be the same thing and sort of think about the probability or the standard or some potential deviation of that value and whether there's more upside than downside. So I don't know if that's a lot to do for an asset, but it's what people do for buying new assets.
So I think at this point, we want to open it up if there's any questions from the audience for our panelists.
Do we have a mic?
You're not that far away.
I'm wondering what your perspectives are on residential rental comp data. There's obviously the lawsuit against RealPage. There's a couple players that are approaching this in different ways. In the U.S., I think we have better data than other markets, but in other markets, we have no visibility into rental comp data or rental optimization data. Is this key? Is it core? Are you happy enough with what's provided to date?
Here we go.
Go ahead.
I do think it's key, especially as it relates to, are you saying for like benchmarking and just understanding where your yield generation came from? Or are you saying for understanding, are you appropriately marked to the rest of the markets? At the end of the day, I think the answer is yes to all of it. The lawsuit, is the lawsuit really related to the availability of information, or it's more related to the fact that it's like a central price system that's really a monopoly and increasing price yields where there's no competition, right? I'm hopeful that it doesn't impact the availability of information, at least in the US. Unfortunately, overseas, there's a lot more issues overseas. It's just the centralization of information, the availability of information. I mean, I'm not sure what the statistic is right now, but for the most part, it's all mom and pop run apartments. Like, there's not a lot of institutional apartments that are out in Europe for the most part. So, I think that answers your question.
I don't really have a view on the lawsuit, and
Yeah.
I wouldn't be surprised if it goes away.
That's a very fair point, yeah.
Any other questions?
Should we bring up Phil?
The Phil show.
Phil
We
is
just
still-
had a conversation with a different group a little bit ago, and one of the topics was about the importance of replacement cost and tying value to replacement cost. And when you asked the question, Alex, of what's the hardest data point to get, to me, replacement cost is a really hard one, especially as it changes. And I'm curious if any of you have thoughts on that issue and how you use replacement costs in your own analysis.
Yeah, that's a really good point. We're talking to as many people as possible to try and figure it out. And it's in a period where construction costs may be very volatile right now. We don't know. But it is a thesis for a lot of investments, is about trying to be, at this point in time, is trying to be below replacement cost. And, again, it's we're picking a number that we think is, let's say, 20% below, but we're pretty aware that there's, there's some wiggle room around that number.
Yeah, for the availability of information as well as the usefulness, we don't really use replacement costs right now for most of the analysis. It's all just DCF driven with, the same way that most valuations are.
I will say that, there's some really good apartment properties in major markets that are, on paper 20% plus or minus below replacement cost, but they're like a 3.8 cap or something. They're priced cheap, and to make the numbers work, you have to assume very strong rent growth. And institutions, investment managers have trouble doing that. It's like, oh, it's going to be 6% growth for the next 8 years or whatever, and they can't do that. But the private buyers are actually doing. They say, it's this much below replacement costs. I don't know when, but it'll get to replacement costs, which means rent needs. So there's a little more. It's a much more important number, I'd say, for non-institutional investors, and then they end up winning the bids. And I think they're going to be. I think they're going to be right. I think there will be some point where, we'll need new construction, and it'll be at a much higher price point than, what they may be buying right now.
And I think just
Yeah, replacement cost is like an interesting one. Like, it depends on the sector, the need for it. Like industrial, obviously, keeping your thumb on replacement costs and everything is obviously really important as it continues to grow and the fundamentals improve. But like, at the same time, it's like doing the analysis across all sectors and the ones that are out of favor, like office, then sometimes if you do analysis based on replacement costs, it can just lead you down the wrong path, right? Okay, I'll pause there. That's a very good question.
maybe one more question.
So it's always interesting with benchmarking because you know your data, you're limited to the data you get. And so, again, we're at an Altus conference, so I'll bring up Altus Data Bridge, right? You're limited to the 8 or 10, points that they give, and you're trying to compare it to your asset, and you say, well, my asset has this qualification, my other asset has this, so you know what's going on with your asset. Or like when we look at our industrial fund, it's like they only own industrial warehouse, so the only thing you have to compare it to is the MSA. At your firms, do you have like custom benchmarks that you use, that you create internally, or that you get from other firms? Or do you rely upon either Altus data or NACREIF?
We don't have enough scale to do our own, so we're relying on those two.
Yeah, we generally rely on those two. The same thing is we just don't have the availability of information. Are you speaking to benchmark returns, or are you speaking to like valuation data? For
Valuation
benchmarking?
data.
So for valuation data, the way that I kind of like to look at it is just historically, like what's been our assets and our books premium to whatever has actually been booked in the past, and just making sure you're following the trend line, just so you have an understanding of the direction of your own portfolio. But I think it goes back to like what we like to have more of is just more and more valuation data. It doesn't even need to be Odyssey data. It just needs to be more core real estate, just to make sure that you're not completely out of whack and out of the market. Because yeah, if there's only like 6 other assets that's within, one MSA, like how comparable is it? I'd love it if it was like 25, right? And so I can actually understand the premium over time when I'm actually trending it. Did I answer your question,
Yeah,
Eric?
no,
Okay,
good.
awesome.